Welcome to another episode of The Brand Called You, a podcast and podcast show that brings you leadership lessons, knowledge, experience, and wisdom from thousands of successful individuals from around the world. I'm your host, Ashutosh Garg, and today I'm delighted to welcome a very senior and accomplished professional from the world of finance and fintech from Singapore, Mr. Steve Davies. Steve, welcome to the show.
Thank you.
Steve is the Chief Executive Officer and founder of Javelin Wealth Management. He's a commentator on CNBC, CNA, and Bloomberg TV. And his other interests include rowing, boating, scuba diving, water skiing, hiking, travel, and investing in established and startup businesses. And he was just telling me that he's finished a 950-kilometer walk across Spain just a few weeks before our conversation. So, Steve, let me start by asking you that as a wealth manager, and I've often asked this from many wealth managers who have come and met me, is that to me, wealth is a combination of cash, real estate, art, and jewelry. But most wealth managers only focus on cash. Why is this the case?
I think that the traditional role, you're quite right, Ashutosh, is private banks have generally tended to focus on portfolios, and the traditional portfolio includes a mix of different liquid asset classes. Those are the assets that they're most comfortable in advising on. But it is indeed the case that people invest in a much broader variety of things.
Correct.
But in each case, they tend to focus on getting specialist advice in each of those segments. So you don't go to your private banker for advice on building up an art collection, or you certainly shouldn't. Similarly, you wouldn't go to your wine expert for advice on managing a portfolio. So increasingly, those things are put in different silos by clients, and clients like to go to best advice for each relevant asset.
I understand. And now coming to Javelin Wealth Management, what is your philosophy when it comes to managing wealth?
The core philosophy is keeping it simple. So I started this company up 20 years ago, exactly, largely because as an investor myself, I found it impossible to get the type and quality of advice that I was looking for at the transparency of fee that I was expecting. I always like to know the terms under which I was investing, and if you can't work out how much you're being charged, or how the portfolio is being managed, or how your advisor is being remunerated, that's a bad position to be in. So keeping it simple is very much the case. Far too much complexity is built into investment products as a means of effectively hiding extra costs. And in reality, most investors, you and me, who are not dyed-in-the-wool financial engineers, we're not trading portfolios on a day-to-day or hour-by-hour basis. So keeping a simple mix, more traditional perhaps, with a mixture of different assets, ultimately is going to be making you better amounts of money and allowing you to sleep better at night.
Fascinating. And based on all the experience you have in working with so many people's wealth, what, in your view, are some of the common mistakes a lot of people make when managing wealth?
Common mistakes, I think, are having unrealistic expectations of risk and return. A common phenomena whenever we're starting off work with a new client is that when we ask them to rate their risk appetite and their expectation of reward, they say their risk appetite is low, but their expectation of reward is high. Obviously, common sense dictates that you can't have high reward without taking on some risk, but ultimately that's what people are conditioned to try and achieve. It's not possible. So you have to have a realistic expectation of what you are prepared to risk and what you think is a reasonable return to take on board for that.
Interesting. And what is the process you follow while you create a personalized wealth management strategy? Because the risk appetite changes as we get older.
Indeed, it does. So the important thing is to start off by working and sitting down with the client to understand what their expectations are, what their goals are, what do they want to do with that money ultimately, and what is their time frame. So it's at that point that we get a good idea of what the appropriate mix of assets should be in order to generate and help fulfill those longer term expectations. Then as time goes on, obviously you will need, quite rightly, as you say, to amend some of those objectives because people get older and their risk appetite may be getting a bit more conservative. But at the same time, their portfolios should be bigger because they will have had compounded returns, and over the years, they will have saved more money into that portfolio. So you've got to balance those out, reweight and readjust on a regular basis and make sure that your assumptions still hold true.
Well said. And there is another big aspect of wealth management, especially when one tries to manage across different tax borders. How do you incorporate the whole element of tax planning?
By living in Singapore.
Say that, but
the advantage is that here in Singapore, we don't have capital gains tax. We don't have tax on interest, income, and dividends. So it's a very favorable environment within which to base a wealth management business and from which to advise people. Nonetheless, it's certainly true that we do advise clients who have assets in lots of different jurisdictions, and in those jurisdictions, tax planning becomes critical. So, for example, if you have assets in the United States, you may not be aware that some of those assets, let's say you hold 100 shares in Apple, were you to die tomorrow, those 100 shares in Apple would be subject to US estate taxes, even if you're not American and you don't live in the United States. So our job as a wealth manager is to point out those risks and to make sure that either those risks are accepted or the portfolio is adjusted to make sure that they're eliminated.
Well said. And that's a very important point, because I know several people who've been hit by this kind of a lack of understanding and had to pay out huge sums of money. The other question that I've often debated with wealth managers is, and you spoke a little bit about client expectations, but markets are generally volatile and markets are generally unpredictable. How do you manage client expectations when you know there is going to be volatility?
Again, I think it's the way in which you manage a portfolio. So we don't trade very much. On an annual basis, perhaps we turn over the portfolio maybe around about 30%. And that in and of itself is at the higher end of what we do. But lots of other managers will turn over portfolios 2, 3, or even more times. Number two, we don't have any leverage or borrowing against our portfolio. So we're eliminating risk from that perspective. But thirdly, again, it comes down to making sure that the client has a good understanding of what the portfolio is for. If a client's looking for short-term gains, they like active trading, then my immediate advice is don't talk to us, go and talk to somebody else, because we don't do that. Our job is to make sure that we're taking reasonable risk for your portfolio to generate a reasonable return over a 3 to 5 year rolling period. So it's not about the returns or the losses that you might generate this month, next month, this year, next year. It's about what the total return is over that longer term 5 year period. And then we manage that portfolio accordingly. The key thing is to have people understand that in 5 years, you're undoubtedly going to get at least 1 year in which you're going to lose money. Guaranteed. You might get 1 year in which you make modest returns, but it's the remaining 3 years that will generate the annualized return over the 5 year period that gets you where you want to be.
Well said. The next question is on technology. And I know that most businesses around the world have been impacted by technology. I'd love to get your perspective on how has technology impacted managing wealth?
Significantly so. The good news is that technology has made the costs of investment a lot lower than it used to be. So, excuse me, when I started the business up 20 years ago, the index fund or ETF space was very much in its infancy. It is now a huge proportion of the managed funds or of the fund management industry. And the consequence of that is that the cost to investors of investing, let's say in the US stock market, has dropped from probably an average of around about 1.2% to now about 0.06. So you can get access to great spread of US companies at a fraction of the cost that you would have been able to get 20 years ago. What does that mean? It means that you're spending less money on fees, and fees act as a core drag, which has a direct bearing on performance. So performance improves because costs go down. So that's number one. That's the effect of technology in giving investors new products with which to invest. From a wealth management perspective, technology enables us to do more with less. So 20 years ago, I had a team of 12, 13 people. Now I have a team of 8, and we're running multiples more money than we used to because technology has made the difference. We can run our portfolios more efficiently and at a lower cost than we used to, and we get better performance as a consequence.
And I'd love to also get your perspective on cryptocurrency and blockchain for managing wealth.
I'm 60 years old. I always like to invest in things that I understand and know where the risks are. So blockchain, which I think has got tremendous potential, is not an area of the market in which we have, in my view, adequate oversight in terms of where the risks and where the main players are. So we say to clients, if you want to invest in that area of the market, that's great. And certainly it has a huge amount of potential. But you should use a different pot of money for that because it's not the style of money that we look after, which is inherently a bit more conservative.
And what about crypto? I mean, a lot of people are putting serious amount of wealth into crypto, into the various products available, starting with Bitcoin. And I know some people have made huge money, some people have lost huge money. What are your perspectives?
It's a nascent market. Yes, I agree that cryptocurrencies, again, like blockchain, which is the underpinning technology, have very, very good potential. But we can see, as was the case with the collapse of FTX earlier on this year, there are still huge uncertainties. And again, it's one of those things that it's good to have a little bit of an exposure to, but operate that as more of a watching brief than anything else. You'll recall that private equity was paying vast premiums for crypto players in 2020, 2021. And I would struggle to suggest that many of those people are making money on those investments now.
Correct. Agree with you. My next question is the importance of estate planning. You did speak about estate tax in the US, but from a wealth management perspective, how important is estate planning management for clients?
It's absolutely critical. It may or may not surprise you that whenever we sit down with clients, one of the questions that we ask as we get to know people is, have you actually written a will? And a disconcertingly large proportion of people say they have not.
Correct.
Either because too busy or I don't feel I've got enough money to warrant having one, or I don't want to confront the issues of the fact that I'm going to die at some point. It may be a combination of those things or indeed something different. But if you think about it this way, writing a will means that you are making life easier for your family by telling your family and your beneficiaries how you want your assets to be divided on your death. It's not fair to leave that decision to somebody else, because that somebody else, if you haven't written a will, ends up being the government. Do you want the government to be the one who decides how much money your children and other beneficiaries, your wife, other charitable institutions, do you want the government to be the one that's making that decision? I'm almost guaranteed to expect that your answer to that, no, of course not. Well, that's what you're doing if you don't have a will, and a will is the core document behind any estate planning strategy. So number one, we sort that out and the rest will naturally follow.
Well said. And I agree. I mean, I don't think anyone can underscore the importance of a will. I think it's incredible how, and how you've explained it really well. So, Steve, now I want to talk to you about what you're passionate about, and we were talking about this, and you said that you're now focusing a lot on what's it all for. And I think that's a question that is often being raised and discussed by people. You said you're 60, I'm 66. People are now beginning to say that, well, our runway is getting shorter and shorter, and I've earned all this money. A lot of it will go to children, but what am I doing it all for? I've also heard people say that one more zero added to my net worth is not going to change my lifestyle. I'd love to get your perspective on what are your thoughts on what's it all for, and how are you advising clients?
Yeah, I mean, it's a very critical point. And you mentioned my walk across Spain a little bit earlier on. Well, I walked along the Camino de Santiago, which is an ancient pilgrimage route in Spain, for 950 kilometers about 3 or 4 weeks ago. A wonderful experience, and one that allowed me time for reflection, time to think about family, friends, business, and other things. But most particularly, it was time off. I'd been running and building my business for 20 years, and I felt that it was a good moment to take some time off to have a think about things for the future. And that's a process. This whole what's it all for was triggered by a conversation that I had with a friend and client who said he was sitting down with his son, who's in his mid-20s, explaining to him about where their investments were. And the son said, "Dad, you work so hard. You've got a lot of money in these portfolios. What are you going to do with it all? And how much do you need?" So, as you say, that extra zero, if it's not going to make a huge amount of difference, then at that particular point, you've got the luxury of being able to take a step back and make a decision and talk to yourself and your family about what you ultimately want to do with it. As Mark Twain once said, you don't want to be the richest man in the graveyard. And I think that's a duty that we have to ourselves and our families to make sure that's not the case.
I agree, but from a very philosophical perspective, while I agree that we'll all go away, how does one answer this question? Because most children, if I can use that term, young adults generally tell their parents, go and spend all the money that you've earned, because we are earning ourselves. And yet people of my generation continue to want to say, oh, we want to leave something behind. What are your thoughts on what should an ideal situation be? Ideal may not be the right word, but what should what are some of the perspectives that you would want to share with people?
I think have that conversation. Have that conversation with your family to get an idea of what expectations are, what needs are, and once you have that conversation, then you're going to be able to start answering that core question. Let's face it, you and I started our careers in the 70s and 80s. We were able to buy properties cheaply. We were able to have good careers, which in many respects you stayed at doing either that or something very similar for your entire working life. Things are a bit more uncertain now. Things are a lot more expensive. The cost of buying that first property, for example, for younger people these days is beyond the means that they might have from their salary and their ability to borrow against it, even if you wanted to. So perhaps as older people, we have a duty to make sure that those things are properly taken care of. Once you've taken care of that and you've written your will, then you can decide if there's anything left over, what else you might want to do with it. You can also set up trusts. So trusts or legacies for grandchildren, future grandchildren, charitable endeavors. All of those things can be built into part of that what's it all for discussion. And the more buy-in you get from your family members, the better everybody's going to feel about it, because they've been involved in the discussion and it will have been a collective decision as much as anything else.
Wonderful. Thank you. Great response. So time for two more questions for you. My next question is that how can individuals ensure that the wealth is being managed in a way that aligns with their long-term goals and values?
Ask questions. That's absolutely critical. Far too often, I think that people make the assumption that because their money is being managed by a big brand name, that it must be being looked after properly and that it must be helping me to achieve my objectives.
Right.
I may not surprise you by saying that very often the objectives of that very large organization versus your objectives could be quite different things. They're obviously going to be looking to make a profit. That in and of itself is not a bad thing, but at the same time, they must make sure that they're doing their best for customers. And we've unfortunately seen far too many occasions on which that latter has not happened. The profit motive exceeds the best interests of the client. So it is your job as the client to make sure you're always questioning and asking, why am I invested in this and what's it doing in my portfolio and why is my portfolio structured the way that it is? And if you don't get a straight answer, then at that particular point, you should start thinking about who would be better placed to help you achieve the objectives with the transparency that you're looking for.
Thank you. And my last question to you, and this is for the thousands of young people who will be listening to our conversation. Based on all your amazing experience as such an accomplished wealth manager, what would you say are 3 lessons you would want our young viewers and listeners to take away as they start planning their wealth management strategies?
So this one, everybody will always start with the first thing, which is start early. The earlier that you start, the better it is, because then you benefit from compounded returns and compounded growth rates. So that's number one. Don't leave it until you're 50. Start earlier. When you've got a bit of spare cash, just put it to one side. It means that you can cope with higher levels of risk, higher level of volatility, and over time, it's going to pay off. Number 2, don't get distracted by the noise. This may not be great news for you or me, Ashutosh, but turn off the TV. Don't bother listening to people on Bloomberg or CNBC or anything else when times are getting volatile, because sound bites do not make you money. Have a look at your portfolio. Think about what has changed. If something has changed from when you invested your money originally, then maybe change it. Otherwise, stick with it. It will undoubtedly still help you to achieve those longer-term objectives. And number 3, always keep a little bit of money in reserve. Try and avoid excess levels of leverage. Some people are very good at managing leverage, others are not, but it does mean you lose more sleep when things get volatile. So separate your money into little pockets. Some are higher risk, some are low risk, but the bulk is in the middle, and that's where you're most comfortable.
Well said. And these are all 3 great points. And on that note, Steve, and your 3 wonderful lessons: start early. Second, you said don't get distracted by the noise. And third, you said was always keep money in reserve. Thank you so much for speaking to me about so many different aspects of Javelin Wealth Management. Thank you also for speaking to me about this very, very critical question of what's it all for you? I think this is a question that as I get older, a lot of friends ask me, and I'm so glad that you are actually taking it up as almost like a professional input to a lot of people. Thank you for speaking to me, and good luck to you.
Thank you.
Thank you for listening to the Brand Called You videocast and podcast, a platform that brings you knowledge, experience, and wisdom of hundreds of successful individuals from around the world. Do visit our website www.tbcy.in to watch and listen to the stories of many more individuals. You can also follow us on YouTube, Facebook, Instagram, and Twitter. Just search for the Brand Called You.